When the Federal Reserve cuts interest rates, it makes headlines. Markets react, investors celebrate or panic. But behind the scenes, something far more subtle starts happening in the banks. And if you understand how banks respond to lower Fed funds rates, how they adjust borrowing costs, how quickly they pass those changes to customers, and what that means for their profitability, you can make smarter investment decisions. Because this isn't just about banks making more or less money. It's about how those shifts ripple into real estate lending, business financing, and ultimately, the entire economy. So in this video, we're going deep. We'll talk about the mechanics of Fed funds, rate cuts, why some banks adjust faster than others, the difference between asset-heavy and liability-heavy banks, and how changes in net interest margins can supercharge or slow down real estate investing and broader economic growth. Before we get into the impact, let's make sure we're on the same page. The federal funds rate is the interest rate banks charge each other for overnight loans of reserve balances. It's not the rate you pay on your mortgage. It's not your savings account, APY. But it's the anchor for nearly every other interest rate in the economy. When the Fed lowers the target rate, it's trying to stimulate borrowing, spending, and investment. Cheaper money encourages consumers and businesses to take on new projects, buy homes, and expand operations. The key thing? The Fed funds rate is a short-term rate. It moves quickly. But the rates you and I pay or earn depend on how banks pass those changes through. Now here's where it gets interesting. When the Fed cuts rates, not all banks react the same way. Some lower their lending rates almost immediately. Others hold off. Why? It comes down to the bank's balance sheet. Think of a bank's assets as the loans it's made, mortgages, business loans, credit cards, and its liabilities as the deposits it owes, checking accounts, savings accounts, CDs. An asset-heavy bank earns most of its money from interest on loans. When rates drop, they can quickly offer lower loan rates to attract more borrowers because the cost of their own funding, the deposits, may not change much right away. A liability-heavy bank is more dependent on paying interest to depositors to keep funds flowing in. They may be slower to cut rates on loans because they're locked into paying higher rates on existing deposits. Lowering loan rates too fast could squeeze their profit margins. This brings us to net interest margin, NIM. NIM is the difference between the interest a bank earns on its assets and the interest it pays on its liabilities as a percentage of its total interest-earning assets. If a bank lends money at 6% and pays 2% on deposits, its spread is 4%. That spread is the lifeblood of bank profitability. When the Fed cuts rates, that spread can change in surprising ways. If a bank's funding costs drop faster than the rates it charges on loans, NIM widens and profits go up. If loan rates drop faster than funding costs, NIM narrows and profits get squeezed. So who moves first? In general, banks with a lot of non-interest-bearing deposits, think checking accounts that pay little or no interest, are in a better position when rates fall. They don't have to lower what they pay depositors much, but they can still lower loan rates enough to compete and grow their book of business. Online banks and institutions competing aggressively for deposits often have to adjust more slowly. They may have promised depositors high yields on CDs or savings accounts, and those commitments keep funding costs elevated for longer. That's why, after a rate cut, you might see some banks advertising lower mortgage or commercial lending rates within weeks, while others barely move. Now let's connect this to real estate. If you're an investor, lower Fed funds rates often mean lower borrowing costs. Eventually, the speed at which that happens depends on which bank or lender you're working with. Local community banks and credit unions, especially those with strong deposit bases, might pass rate cuts through faster, meaning you can refinance sooner at a better rate. National banks with heavier deposit competition might lag, keeping rates higher for longer while they protect their margins. If you're shopping for financing, understanding a lender's profile can help you target those most likely to give you a favorable deal quickly after a Fed cut. Now here's the twist. While lower rates can eventually mean cheaper loans for investors, they can also lead to higher net interest margins for certain banks in the short term. Why is that important? Because higher NIM means banks are more profitable and more willing to lend. When banks are confident in their margins, credit standards can loosen a bit. That makes it easier for investors to secure financing for acquisitions, rehabs, or development projects. More lending means more real estate deals get funded, and that can put upward pressure on property prices. especially in competitive markets. But the story doesn't stop at real estate. When banks enjoy higher net interest margins, their profitability boosts stock prices, increases their ability to invest, and can encourage expansion in other sectors. Businesses can borrow more cheaply to expand. Consumers can refinance debt, freeing up spending power. And local economies can see a surge in activity, from construction to retail to services, because financing is easier to get. It's the classic monetary policy transmission. Rate cuts, bank margin dynamics, increased lending, economic expansion. Of course, it's not always smooth sailing. If banks have high levels of bad loans, or if they're facing regulatory pressure, they might choose to hold on to extra margin rather than expand lending. If economic uncertainty is high, banks may keep credit standards tight even if rates drop. And if deposit competition is fierce, say because investors have better options in money market funds, banks may still pay relatively high rates to depositors, keeping NIM from improving much. In those cases, the pass-through from Fed cuts to real estate borrowing costs can be much slower. So how can you play this as an investor? First, shop your financing aggressively after a Fed rate cut. Don't assume your current bank will offer the best terms. Second, build relationships with lenders who tend to adjust quickly. Community banks and credit unions often fit this bill. Third, if you already have adjustable rate loans, watch for when your index rate moves lower, your payments might drop automatically. Fourth, time refinances strategically. You don't have to jump at the first sign of a rate cut. Sometimes waiting a few months allows lagging lenders to catch up and offer better terms. When you zoom out, the Fed's decision to lower rates is about more than just cheap debt. It's about influencing the flow of money through the banking system. Banks that benefit from widened net interest margins will often lend more, invest more, and stimulate more economic activity. That can accelerate job creation, boost GDP, and in turn, create a more favorable environment for real estate. But if banks' margins are squeezed, or if they're cautious because of broader risks, the impact can be muted. Understanding where banks are in that cycle gives you an edge. Whether you're investing in property, stocks, or even choosing which bank to park your own money in. Lower federal funds rates set off a chain reaction. Some banks move quickly to lower borrowing costs. Others take their time. Asset-heavy banks may jump at the chance to grow loan portfolios. Liability-heavy banks may guard their margins more carefully. For real estate investors, the sweet spot is when lower rates and higher net interest margins align, because that's when lending is plentiful, rates are competitive, and deals can move fast. The next time the Fed cuts rates, you'll know exactly what to watch for and how to position yourself to take advantage of the changes.